Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Hey, good morning, folks.
Good morning, everybody. Welcome to another Wealth Coffee Chat.
Hope you're well, folks, wherever you are.
There it is, team. Morning. Morning, wherever you're tuning in from today.
Early bird gets the worm, they say. Here at Positive, we offer a 6-star team. It's a team that help you at every stage of your wealth creation journey.
General advice disclaimer. The information provided is general in nature and does not take into account your personal objectives, financial situation, or needs. Before acting on any information, you should consider whether it is appropriate for your circumstances and seek professional advice from a licensed financial advisor. While every effort has been made to ensure the accuracy of the information, it is not guaranteed. It is based on our understanding of regulations and laws as at the publication date. As these are subject to change, you should talk to a professional advisor for the most up-to-date information. Any examples or illustrations provided are for illustrative purposes only and are not a guarantee of future performance. We do not accept any liability for any loss or damage incurred by reliance on the information provided. Any opinions expressed are subject to change without notice. Past performance is not indicative of future results, and all investments carry risks. Neither the hosts, guests, nor any affiliated entities accept liability for any loss or damage arising from reliance on the information provided. By listening to this podcast and viewing this presentation, you acknowledge and agree to these terms.
Good morning, everyone. Welcome to another episode of Wealth Coffee Chats with myself, Alex, talking all things financial planning, markets, and other things related to that. A lot to unpack this week. So last week was a little bit slow, but this week we've got a number of things to chat about. So for those, just before I get into it, for those who were lucky enough to get to the pop-up mentoring sessions last night in Melbourne and Brizzy, I hope you guys had a good evening and learnt a lot from it. So I was at the Melbourne one, and there were we had Sam Saggers there giving us an update on the property market. All the major cities where the market is looking to thrive and where the markets are looking to sort of slow down. So awesome evenings. I think that's about it for the year. But next year, if you've got time, I would highly recommend getting down there and listening to these experts. Sam, is always good value with his insights. So yeah, great night last night. So if you were there, put a thumbs up in the chat. Otherwise, let's dive into today. So let's have a look. We've got Pat online. Morning, Pat. Good to see you, mate. So let's dive into today's couple of topics. So a few things. Let's look at the markets, right? Like what's going on? We've had such a great year so far, and everything's been trending upwards. But the last sort of month, we've seen some negative sort of results. The markets are retreating a little bit. I'm just having a look at the numbers. The Aussie market is down about 7%. And the top 500 in the US is down just under 4% over the last month. So, for the year, we're still trending quite good, but the last couple of months have contributed to lower performances. So, if you look at the state of the economy, there's a little bit going on in terms of the AI and sort of views on are we in the middle of an AI bubble? Are we what's going on? And I think Nvidia, who just reported before I jumped onto this, there was a lot of speculation about how they're able to provide and deliver these results, which if you don't know and if you haven't seen, they actually reported their biggest results for the year. So, and that should actually provide a positive result on its share price. So I guess some of the background story there is Nvidia is investing in OpenAI, which is we know there's a lot of sort of different AI startups. But the way the reporting works is their investment essentially gets back to them because OpenAI requires a lot of computing power and chips and all of that stuff. So whatever they've invested comes back to them via these sort of services, right? So on the books, there's a couple of people have noticed that, and now it's becoming a bit of a sort of breaking news. How can this happen? But ultimately, it's not a new thing. A lot of businesses do that. So yeah, but either way, they've reported, they've got some really good numbers. What have we got here? Let me just have a look. Literally, this has just dropped like 10 minutes ago. So revenue 57 billion. Expectation was about 54 or 55. So yeah, huge results. So other markets, crypto, gold, crypto is having a relatively sad time at the moment. I'm just looking at the numbers. Bitcoin down 26, Ethereum 35, and that's percent, right? So Bitcoin, essentially all the gains for the year have been wiped away. So it's sitting at a break-even point, I should say. Gold is also down sort of around 5-6%. So, just looking at the reasons behind it, right? So, risk-off sentiment, that's essentially people are taking a step back from all the risky assets, especially, gold has run up quite strong. All the cryptos have run up quite strong as well. So there's a lot of profit taking, and with the recent AI sort of bubble sort of conversation, people are taking a little bit off the table as well. We've got Jeff here. Yes, Jeff. I didn't see that before, but yes, yeah, buying the dip. So that's not advice, but yeah. We've got Tim jumping on as well. Tim, yeah, I just mentioned. So with the AI, like I said, there's a bit of uncertainty around how the money flows and how these numbers are sort of coming through, and all record numbers within the AI space. So and there's it's a developing space, so there's a lot going on in there. So yeah, but look, ultimately, like I said, Nvidia just reported good results. It's probably going to have slightly more volatility moving into it. The price of the companies that are engaged in it, Nvidia, Microsoft, Google, all of those guys, they're investing heavily into that space. So look, that's the markets, right? The markets are, that's the nature of them. They are, up and down. Actually, the other cause as well that's forcing the markets to react the way they are at the moment is there's a bit of a view that the interest rates, in Australia, we're done with the interest rates for the year. In terms of any sort of rate cuts, might be mid next year. With the US, they're expecting a rate cut in December. It's looking unlikely at this stage. So, and that's causing a bit of a market movement as well. So that's all I wanted to talk to you about on the markets. But another thing that I sort of missed, and I'm a couple of weeks behind on it, but ASIC, right? So the financial regulator has come out with a self-managed super fund report a couple of weeks ago, so start of November. Super important. If you're interested in having a read about it, it's report number 824. But essentially, they just provide a bit of an insight into the SMSF space. So self-managed super funds. So this is where you use your own super fund to invest into, invest and manage your own superannuation, as opposed to having, like an Australian super or like a Colonial First State as the super fund for you. So a couple of cool things in that report, right? So number one, they're highlighting that the asset base of the self-managed super fund, so all the assets within the self-managed super funds have now hit 1 trillion, right? And that's a super important number because the total superannuation space is valued at about 4.3 trillion, right? So all of a sudden, or maybe not all of a sudden, but the self-managed super fund is now comprising 1/4 of the total superannuation assets. So, and this is a big jump. If you look at how long self-managed super funds have been around, it's only been 25 years. Like I think the early 2000s, like like 99. I think that's when they sort of came into play. So the first adopters were really not your sort of everyday individual, but now they're highlighting the risks around setting up the self-managed super fund. And if you're a client of mine, I always take my clients through a detailed session on self-managed super fund, outlining all the risks, all the positives that will bring you, plus all the compliance stuff, right? So they're very focused on the compliance of the self-managed super fund, as well as the reason behind you actually having this entity set up. Because what their main mandate is to make sure that people have funds for retirement and not just go in there, buy Bitcoin, it crashes 26%. And then, they're left with nothing, because it is in the government's interest for us to be self-funded retirees, because with the aging population, this would create pressures on the Centrelink and H pension and everything like that. Let me have a look, Tim. What have we got? There's been a big push lately for people to invest property in self-managed super fund as BC capped out, borrowing capacity capped out normally. Look, and this is what they, and this is right, Tim. So, and this is what they're looking at, right? So they're looking at what is the reason behind setting up a self-managed super fund? Because ultimately, if you hold a self-managed super fund, who's the responsible person for it? Well, it's yourself, right? The people who are managing it. It's not the advisor, it's not the accountant, it's not a solicitor, right? Their job is to help you manage it, but the ultimate person that's responsible for it is yourself. So, and they're probably seeing that the super fund is being used predominantly for property acquisition, which then, in effect, it creates one asset within one entity, which then creates limited diversification. So, when I look at my clients and my conversations with them, I always say, look, if you want to invest into property and this is something that makes sense for you and whatnot, we need to have a side strategy to make sure that we diversify out of just one single asset. There's many reasons for it. Like it's like having all of your eggs in one basket by having one investment. But also, in terms of liquidity, you want to be able to provide liquidity if something happens. You might not have a tenant, or you have to spend some money on the property. And if your entire balance is invested in this one asset, then you're kind of stuck, right? So you always have to have a strategy on the side here. So the other cool thing that they mentioned, there's a lot in this report in terms of what they're looking for. So yeah, they're very focused on why and the compliance side of the equation. So don't be surprised if you have a self-managed super fund and you get audited by them, just to sort of check that everything checks out. But the other interesting stat that they're talking about is an average age for the self-managed super fund members, right? And they're sort of saying that age is around age 45, right? So which means that majority of the people, they're not really in their retirement phase. They're probably pre-retirement. And then going back to your point there, Tim, about buying property inside self-managed super fund, that's probably typically roughly where you would probably start doing that. But again, it has to fit your strategy. The only thing they're looking at is, does this put you in a better position by you doing this, right? If they see a self-managed super fund that is struggling with cash flow, that has no diversification, that's a red flag for them, and they're going to be looking at that and flagging that with the rest of the with you, essentially. That's where you might receive a little tap on your shoulder to please explain. But the interesting thing is that how much the self-managed super fund has grown over the last 25 years. And it's now a real player in the mix. It's always been a real player, but it's now a more dominant player. 1/4 of the overall superannuation assets. So given where things are going, it's likely to continue to grow. And from your perspective, if you're investing through a self-managed super fund, you just got to be aware of all these compliance responsibilities that are that you need to be following, and ensuring that you stay compliant overall. So yeah, look, a couple of things. If, like I said, if you want to jump on to the ASIC website, it's a report number 824. It has a lot of information for advisors. It has information for just regular retail investor. So yeah, jump on it, have a look at it. But in a nutshell, the markets are a little bit choppy at the moment. We talked about the reasons for that, and the self-managed super fund is now becoming a major player, more so than before. So something to look out for, and if it fits your strategy, then perhaps something to look at as well. So if you've got one, great. If you don't, then look at whether that's appropriate for you. But don't just dive into it just because someone said, hey, buy a property using your super. So there has to be a solid fundamentals behind the reasons as to why you're doing it. We've got a message from Tim. So insurance, I have outside my SMSF, but they want extra within. Look, so Tim, just on that real quick, the super fund, as part of the requirement, you need to have an insurance consideration. So, and that has to be documented. So that's one of your requirements. So if you've got insurance outside, then you can document that to be part of your SMSF strategy. Otherwise, if you don't, then you need to provide reasons as to why you don't have it. It's all about documentation, and this is where time frames. You need to allocate time to do these things, and if you don't do it properly, then that's all kind of falls back on you from a compliance perspective. So anyway, I hope this was a great sort of update for you guys. Hopefully, we will get some more juicy stuff for next week, and then we'll update you on that as well. So enjoy your week and your Thursday and Friday, and we'll catch you next Thursday. See you later. Bye-bye.
Thanks for watching another episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes are also available wherever you get your podcasts, folks, as well as our other podcasts from the 6-Star team here at positivementor.com.au.